When you hear the term qualified plan, what does that mean? Is it just a fancy phrase, or does it actually matter for your retirement? A qualified plan is a retirement plan that meets strict requirements set by the IRS. Rules designed to protect you, the employee, and provide tax advantages for both you and your employer. One popular qualified plan many of us know is the 401k. But what makes a plan qualified? The foundation of these rules comes from a federal law called ERISA, the Employee Retirement Income Security Act of 1974. ERISA is like the guardian of employee retirement plans. It guarantees certain rights for participants and sets minimum standards for how plans must be designed and managed. When a retirement plan qualifies under ERISA, it means good news for both employees and employers. Employers get to take immediate tax deductions on the money they put into the plan. Employees get to make contributions and grow their savings on a tax-deferred basis. That means you don't pay taxes on your contributions or the investment earnings until you withdraw the money later, usually at retirement. But to be qualified, a plan must meet some important requirements. First, the plan has to be a definite, written, and permanent program, not something vague or temporary. It must be clearly communicated to employees so everyone understands the benefits and how the plan works. The plan must follow what's called the exclusive benefit rule. That means the money invested in the plan can only be used to provide benefits for the employees participating in the plan and their beneficiaries. No funny business or unrelated expenses. Also, the plan cannot discriminate in favor of certain groups, especially highly compensated employees or HCEs. This rule ensures fairness, so the benefits aren't just for executives or top earners. To check for fairness, plans must undergo special non-discrimination testing. This testing makes sure contributions and benefits don't unfairly favor the HCEs over the non-highly compensated employees, or NHCEs. Speaking of HCEs, who are they exactly? Generally, they're employees who either own 5% or more of the company, or earn more than a certain income threshold set by the IRS each year. Everyone else falls into the NHCE category. If a plan passes all these rules, the IRS sends a letter of determination to the plan administrator. This letter officially recognizes the plan as qualified and eligible for all the tax benefits. Why does all this matter to you? Because a qualified plan means your retirement savings are on solid ground, protected by federal law, and working with important tax advantages. It's a win-win. Employers can offer valuable benefits while employees get tools to build a stronger financial future. Remember, these rules and income limits can change over time. For the most current information, check with the IRS or Department of Labor. Up next, we'll explore the specifics of 401k contributions, including how much you can save and what employer matching means for your nest egg. Thanks for listening. You're building valuable knowledge step by step.